Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Welcome back to our mini-series on paying less in taxes in retirement and Roth strategies. I am Rick Durkee, president and founder of the Coastal Financial Planning Group, and also your host on Navigating Retirement. Let's continue our discussion today on Roth accounts and how to control your taxes in retirement. So here's a little review quickly. On our last video, we talked about strategies for higher income earners. Now let's talk about how anyone can maximize their Roth contribution opportunities. We always want to look at risks, issues, and opportunities when we are planning for our retirement. Today, we're going to talk about some more opportunities for anyone to maximize their Roth contribution. Hey, remember, contributions are subject to limitations, right? And we want to take advantage of all we can when we're putting away tax-free dollars for our future. Please carefully consider the pros and cons of any financial move and its tax consequences with your team of financial professionals. But here's some quick strategies for maximizing your contributions on your Roth IRA. Number one, the married double up. Okay, if you're married, you can make contributions for each spouse, even if only one has earned income. So if you have a stay-at-home mom or a stay-at-home dad, instead of your $6,000 that you can typically contribute, now you can put up to $12,000 a year in new contributions. Number two idea here for maximizing contributions is use your return. Getting a return this year from your taxes, okay, consider contributing it right back into a Roth IRA. It can make for a great jump start and an extra boost for your contributions for next year. Now, here's a bonus for you. If you look back and you say, I could make a contribution between January 1 and April 15th for last year and this year's contribution, you could do a catch-up and make contributions for both years. This could be huge. A married couple then, over 50, could get up to $28,000 into their Roth all at one time. So let's move on to number three, contributing over the match. If you're contributing to your company 401k plan over the amount that is matched, sit down and speak with your financial advisor, your tax professional, and talk about the benefits and disadvantages and the long-term results of repositioning non-match contributions into a Roth IRA instead. If you maxed out your IRA, then you may want to return to the Roth IRA at work, which is our number four idea. If your company offers a 401k, they may offer you the ability to decide to pay your taxes on your contributions as they are made in a Roth 401k. This will lower your net pay as you'll be taxed on the net contributions. Roth 401ks offer much higher contribution amounts. This is important to know than IRAs allow. $19,500 in a Roth 401k versus $6,000 in a Roth IRA if you're under 50, or $26,000 in a Roth 401k versus $7,000 if you're over 50. Remember, your company will not pay the taxes on their matched portion. This will remain tax deferred. Number five idea, working over 70 or 72. You can still make Roth IRA contributions regardless of your age. Let's not forget this. The government gives us a mulligan here. We can work as long as we want and still contribute into our Roth IRA regardless of age. So us boomers that want to keep on working through our 70s, we have an opportunity here. Number six, doubling up. You can take advantage of both workplace plans and your personal IRAs, but certain limitations may apply. Let's do a little quick math here. What's the maximum a couple could contribute to Roths in a given year? It might be possible to get as much as $80,000 into that Roth This is husband and wife max for this year and last, and both max workplace plan contributions for the 401k that's a Roth at work. So this is food for thought. Also, what if you get an inheritance? How could we use that money to get in a Roth? Certainly, if you want to find out more about that, stay tuned with our future episodes here. Let's recap really quickly here. We want to take advantage of every opportunity to get money growing in tax-free accounts for the future, right? We want to keep the partner out of our future retirement dollars. The IRS got to stay out. These are just a few concepts to get more and keep more in retirement. In our next video, we're going to discuss specific strategies for making conversions of tax-deferred dollars already in retirement accounts. So stay tuned for our next video on how to make more and to pay less in taxes.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.